Hey, good afternoon, everyone. This is Mark from Right Line Trading, and thanks for giving me your time this afternoon. And what I would like to talk to you about is trading options. And I thought I would start out in a little bit differently than normal. And what I would like to do is I do have a lot of information to tell you, but we have an options portfolio. And what I'm going to do is I'm going to show it to you. It's right here. Now, I believe in creating a diversified portfolio of options. I mean, I'm an aggressive options trader, and I don't ever hang my hat on one option spread, one call. Most options traders, options portfolios really hone down on one or two recommendations, and you rise or fall on just those. So here's all the spreads we have in the portfolio. You can see how well it's doing. This is optoelectronics. It's down. Amgen is up $1.94. Xilinx 69 cents. Axon up 3 cents. This is Raytheon $2.63. Albemarle is a manufacturer of lithium. Freeport McMoran is a manufacturer of zinc. Microsoft, this is DuPont, this is Corning, this is Qorvo. It's a major chip maker that provides chips to Apple for their iPhones. Here's Apple, here's Amcor, here's Salesforce.com, Autodesk, Amazon, Home Depot, Alibaba, Lowe's, and this is Take-Two Interactive. And the one thing that you'll see about the portfolio is it's diversified. I've got a blue chip, which is DuPont. We've got tech, like Apple. We have big caps like Salesforce.com and Autodesk. We've got Home Depot and Lowe's. We've got a company that makes video games in Take-Two Interactive. We've got a company that mines lithium, one that mines zinc, Raytheon, a defense, Amgen biotech. So one of the most important things is that you, and this is information that's rarely taught, is that you need to create an options portfolio just like you would create a stock portfolio. You're not going to buy 2 stocks or 3 stocks and put all your money in those 3. You're going to buy a diversified portfolio of stocks. And what I do is I create a diversified portfolio of options. We've already closed out 125 positions so far this year. Now, Benzinga Pro is really an integral part of how I trade. I'm going to show you how to use that later. So I'm going to just put that in the background and put the slides back. But I wanted to show you how our portfolio is doing today. It's really doing extraordinarily well. Now, I don't know why Alibaba is trading soft today. And DuPont is trading soft because it's a defensive. I mean, it's a blue chip. And right now, money's going into tech. But when tech falls and money moves into the defensives, DuPont goes up. And you can see Raytheon here is on a rocket. And the biggest percent mover is Albemarle and FCX, the miners, zinc and lithium and zinc. Now let me go back, and I'm going to show you how to create these, how to pick stocks that are most likely to rise, and how to configure a spread so that it gives you the best risk to reward and the best percentage or best chance of winning. Now, let me go back to the slides and just give you a little bit of background about myself. Let me go up to the top here. Okay, I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson. I've published about 15 peer-reviewed articles, and if you put Sachs MK into Google, if you put parentheses around them, they'll come up better. Many of them, most of them are still either second page, third page of Google, even though I published them quite a number of years ago. And I've been involved in the financial markets for over 20 years. And I began trading futures Forex a long time ago, stocks 25 years ago. And what we do at Rightline is we're involved in the optimization of our software. We look at predicting the future movement of price as we look at price on any financial instrument as a closed system. And there's certain forces that come to bear on price, and those are called independent variables. We determine what those are, we put them in a multivariable equation, we optimize it, and then we're able to predict how any financial instrument is going to move out into the future with a great degree of precision. And I said that real quickly because it's really not, it is relevant. I'm going to show you how we do it, because when you trade options, and I'll show you what are two of the killer problems with trading options, and I'll show you how we try and sidestep it. Can't always sidestep it. We have about 70 to 75% of our options trades winners. About 20 to 25% are losers. And we make far more on a winner than we lose on a loser. So not only are we trading 75% over 25%, we make much more money because I'm going to show you how to control risk. If you risk $1, you want to try to make $2. At worst, make $1.50. So you're going to make more money on your winner than you will on a loser. Now, this is just a slide I threw in there because a lot of people are frustrated trading options, and they spend a lot of money buying expensive mentorships. And I don't think the mentorships teach you what you really need to know. And I'm going to show you a mentorship that I offer that's really cheap, and it does teach you the nuts and bolts of how to trade. And because it shows you how I trade, and I do trade profitably, and I take all my options trades in my live account. And if you're a member of our options alert newsletter, you're welcome. You're welcome to request that. I take every trade live. My position is open at the time I send it out, and I send out the entries and the exits, and the price. And I am always open in the portfolio at the time. So I make the exact amount of money or lose the exact amount of money that you do. I mean, I back up what I pick with my own money. And I have a lot of money invested in my options portfolio. Now, 80% of options traders do consistently lose money, and only 20% of options traders make money. And this is a little bit of a pitch, but the truth is, why can't the losers give their money to you? And it's really the truth. And if you do give me the opportunity, I'm going to show you how to trade options profitably. Now, 95% of the stuff that you learn in webinars or that's sent out to you in these free ebooks and these free e-zines and the filler for most of these mentorship classes, you can really learn in trading options for dummies. I mean, all the options configurations, the spreads are all in this book. And if you really learn this book thoroughly, I mean, you'll know how to create an iron condor or a butterfly or any type of vertical spread, whether it's a plain vertical spread or a calendar spread. But it doesn't tell you how to optimize reward, minimize risk, how to find the most profitable option spreads, and which stocks to pick. Because I mean, I get in my spam email, I mean, if I believed everything I read in spam, I would be able to live to be 500 years old because I could take a pill that would reverse aging. I could get a mail order bride. I'm a single guy for $4.95. All I would have to do is put in an order, and they'd mail me one from Russia who would love me for the rest of my life, and a whole lot of other things. And what I get in spam email are a lot of these representations where you're going to make enormous amount of money on zero risk, and that's just never going to happen. But almost everything that you need to know with regard to the fundamentals of trading options are in this book. And in this 4-hour course that I teach, I'm going to assume that you know all of this. I'm not going to go into anything that you can get out of this book. Now, the book gives great weight to the Greeks, to spread positions, vertical, horizontal, butterflies, iron condors, all the information that you read, the basic and fundamental principles behind all of these spreads in the Greeks are all in that book. And you do not need to know much more than that in a webinar or in a, I hate to call it a master class, because at the end you may not necessarily be a master, but I'm going to give you all the tools you need to trade profitably. I'm going to show you that, but it's an awesome 4 hours. Now, I'm just going to, I mean, these are just some basic questions that I don't think a lot of people know. If you want to create a straight vertical spread, you can create a bull call spread or a bull put spread. And both spreads have the exact same metrics. And which one is most advantageous for you to utilize? Now, this is information you're not going to get in options for dummies. All they're going to show you are the metrics of the trade, and they'll show you that they're identical. But what I do is when the implied volatility of the spread is low, then the options price is cheap, and then you want to buy the spread. When the implied volatility is high and the options price is expensive, then you want to sell it and take the net credit. So right there, you understand you have a stock, and take, for instance, Autodesk. And for a whole bunch of reasons, you know you want to create a vertical spread. You go and you pick your strike price based on the configurations that I'm going to show you in Thinkorswim. And the Thinkorswim platform is really terrific. And I'm not proffering it to you to get, because I think they're probably equally as powerful in many other brokerage companies. But it's going to tell you essentially the probability of hitting your strike price. And it gives you all the metrics of the spread. Now, if you buy to open a put position and buy to open a call position, do you want to trade an out of the money, an at the money, or an in the money? Now, a lot of people have a style, but each trade has to be configured individually based on the underlying stock and your expectations based on the probabilities of reaching profitability. I mean, you know, if you buy a 32 call for $1, it's got to get to 33 for you to break even. So you're going to determine what the probability is to reach that break-even point based on a probability curve that you can generate easily in Thinkorswim that I'm going to show you how to use. So you have to decide whether you're going to buy an out of the money, at the money, or in the money. Now, the only 3 parameters that I want you to be aware of, because each one of these, creating each one of these positions is really unique to the underlying stock, and your ability to decide based on probabilities how far that stock is going to move. Obviously, the out of the money call is going to be the cheapest, and an out of the money put's going to be the cheapest. But do you want to buy the cheapest option? Is that going to be the best way for you to make money? And so what you have to do is, one thing is you have to know is that if it's inexpensive, it's going to have a low delta and a high theta. So what's going to happen is for each dollar the stock moves, the option's going to increase in price only a small amount. And also it's going to have a lot of time decay. That's going to eat away at your at your option. At the money, it's going to be moderately priced. You have a better delta, and you have a moderate theta. So here you have moderate risk and you have moderate reward. Now, in the money is expensive, but you have a very high delta. For a small move in the stock, you're going to get a very big move in the option, and you have a very low theta. So you're going to lose time premium on that option at a very low rate. So those are just the way you need to apply the Greeks in just a very fundamental way in deciding which kind of option or which kind of put or which kind of call you want to buy if you just take a naked call or a naked put in terms of a purchase. Now, I'm going to teach you how to find the best stocks. I'm going to talk to you about what stocks to avoid at all costs. I'm going to show you that the role of the Greeks and a little bit about risk management. Now, in degree of importance, these are both really important: technical analysis and fundamental analysis. The reason that fundamental analysis is so important is that you need your stock position. If your stock position is likely to rise, if you buy the stock, it could take 6 months or a year to rise. If you're going to buy the option, you've got a problem because it's got to move in your direction in a finite period of time. So that's why fundamentals are so important. But technical analysis remains really critical. If you buy a stock that crashes, and I do sometimes, in fact, I tried to buy one, Take-Two Interactive was a 10% pullback, but you still have to know where the stock is. Has it broken the 50? Has it broken the 100? Is it still in a technical uptrend? Once it's broken all that support, you can't buy a broken stock. So technical analysis is important, but I'm going to show you how fundamental analysis keeps the stock rolling in your direction and keeps it from going into what I'm going to show you is the options killer. So what are some of the fundamental things that we look for? And this is what I look for in Benzinga Pro. I look for, first of all, we know that the administration is going to cut high corporate taxes. And with regards to that, I read a really good article last night. I put all my options trades in at night. So it's really critical you check Benzinga in the morning, because a few months ago, it was like maybe 6 months ago, I put in a spread on Macy's, and before the market opened, Macy's collapsed on bad earnings, and you're able to cancel your trade because the option doesn't trade in the morning. So Macy's was down like 15%, and we could just sidestep the disaster by checking Benzinga Pro on all the tickers we have. It's really going to give you great information on what direction you expect every single position in your options portfolio to move. Most importantly, how they're going to move in your open positions. Because when they're open and it's pre-market, you have the ability to pass or play on them still. And if the stock is collapsed, you can just cancel the trade. So we know that the new administration is going to cut corporate taxes, and they're close. And I read a big article in Benzinga about what stocks are going to profit the most, and it's going to be the banks. because there's going to be a large cut in corporate tax rate. And a lot of that money is going to go to the banks. The other is the defense industry, which is where I have a position in Raytheon, because Trump is really big on pumping up the military. Infrastructure spending, and I've traded a huge number of stocks related to infrastructure. Now, business regulations are going to be gutted, and Yellen is going to be increasing interest rates, but she's increased them at a very slow pace. And the expectations are, since there's no evidence of inflation, that the interest rates are going to stay in an upward trend, but they're only going to move up incrementally, very slow. So we look at specific stock catalysts that help ensure trend continuation. We look for insider buying, and we look for large purchases by real insiders, the CEO and the CFO, taking very large stock positions. That's a good sign that they know something that we don't know, and that stock is going to rise. In addition, like I look for big investors like Warren Buffett, Carl Icahn. Those guys dumping large amounts create great put positions, and them buying large amounts of stock create really good buying positions. Now, Freeport McMoran, the day after we created that position, FCX, Carl Icahn sold 15% of his stake in that company, and our spread was in the dirt. But the fact is that the mining of copper, it's so necessary that FCX has been flying, and it's one of our biggest money makers. But if we weren't in it, what I would have done is I would have bought an in-the-money put, because if Carl Icahn dumps it, a lot of small traders are going to follow suit, and then the stock is almost guaranteed to trade weekly for about a week. It's going to have a lot of weakness. There's going to be a significant greater number of sellers than there are buyers. And if you buy an in-the-money put on a stock that has that kind of fundamental analysis, you're very likely going to make a significant amount of money. Now, broker upgrades and downgrades, they definitely help. But these are more helpful for the stock positions you're in to give you an idea of where they're moving. Because usually that broker upgrade or downgrade punches that stock up, and then you're the last person in. So you got to be very, very careful. And then there's esoteric news. And, you know, I can give you one of the pieces of esoteric news is that I read, again, it was a piece out of the Wall Street Journal about 8 or 9 months ago, that it was in Benzinga, that said that the Defense Department was out of, actually it was before Trump took office. So it's more like a year and a half ago that the Defense Department was out of cruise missiles, because they had fired so many into Syria and into Iraq, and, you know, where ISIS is. And then all I did was check at what company manufactures cruise missiles, which is Raytheon. And I bought a bull spread on Raytheon, and Raytheon just rocketed. So esoteric news like that will move a stock. And if you watch the information that crosses the ticker, it can give you really, really good ideas on how to create bullish positions and bearish positions. Now, the unlock period also, when an IPO reaches its unlock, all that information will cross the ticker. And the unlock is the point of maximal pessimism of a stock. You let it get to that point of optimal pessimism. And then oftentimes, really frequently, 80% of the time, most insiders who have stock positions don't sell them. So the unlock releases a significantly less number of shares than is anticipated. And at the point of maximal pessimism, where traders believe the market's going to be flooded with these shares, you buy off the bottom. And we've done that quite a few times. Now, obviously, FDA is real big. And we've made 100% in 5 minutes on Genentech because of a big FDA disapproval. And we got in quick with a put because I saw it cross the ticker, and we made 100% in 1 hour. And we do have an SMS text messaging service to get you those trades fast, because you have to get in before most other traders do. And we look for other traders taking huge options positions. Now, I don't know if you know the Nigerian brothers, and I can't remember their first names. I think one of them is John. But that's how they trade. They follow the footprint of big money. They wait for somebody to take $1 million or $500,000 options position. They wait for 10,000 options to be traded, and those options are 20 or 30 times open interest, and then they move in right afterwards. And they publish their trades, and they cross the ticker, and you can see exactly the trades that they've taken, and they will tell you exactly what they saw. And they do it through Options Monster, and Options Monster is another ticker that I follow because it really shows you where the big money is placing their bets. And let me tell you, big money is oftentimes wrong. So you have to be really careful, and you have to do good diligence, do good due diligence. But the trades that the Nigerian brothers take, they've already done due diligence on, and they are usually great trades. They just took a trade on Oracle, and they took it right before they Oracle came out with its quarterly report, and they traded it into the report, and Oracle did really well. Then they dumped their positions. Then Oracle reported, and Oracle's down 10%. But what most money was doing was anticipating that Oracle would have a good quarter. It didn't. But the smart money traded into the report and then walked away before the report came out. And these are all ways of creating really lucrative options positions. Now, there are some options positions that I always avoid. And one of them is creating an options position with a stock that has a tarnished brand. And if you remember the Mylan EpiPen issue, where they were like price gouging with it, and they created a generic that was exactly the same as the brand, and it was a whole mess. And Congress got involved, and then remember Hillary Clinton got involved, and she came out with all kinds of news about Mylan. It took Mylan a year to recover from that, and I don't even know if it's back yet. So once a company gets tarnished like that, don't buy off the bottom, because it's going to stay broken for a long period of time. And most smart investors are going to stay away. So consider it dead money and move on. The other position that's really important to avoid, you may see a great stock and a great opportunity on a small cap that does have options on ETFs as well. But if that position is not liquid, if there's a really tiny open interest and volume on the option or the spread on both legs of the option are small, it's best to stay away. It moves really sluggishly. Sometimes the underlying will go up $1 or $2, and the value of your options will fall. And that's because the market makers are constantly trying to find the natural. And the natural is the difference between the bid and the ask. Now, on an option that's heavily traded, that natural position is well defined. But on a spread or on an option where there's hardly any open interest and hardly any volume, that natural is very poorly defined, and the market makers bounce it around. So the value of that spread, it just trades crazy. I mean, one day it can be up 10% on it, and the next day you're down 10%. So stay away from positions that are not liquid, not only because you can't get in or out of them easily, but because it's very hard to determine how much you've made or lost, because the natural position that is determined by the market makers just bounces around like a ping pong ball. Now, here is what ends the careers of most options traders. They take a trade, or they look at a stock that's in full bull mode, and they create a bullish position, but then one of two things happen. It's happened to me. It's impossible to avoid all the time. What you have to try to do is avoid it as often as you can. That's why that fundamental analysis is so important. You want to keep a stock in bull mode and you want to keep it going up. There's got to be a lot of buying interest on your position, because two things can happen. One is it can go into consolidation. I mean, it remains in bull mode, and the consolidation can last from days to weeks to months before a stock breaks out of consolidation, all the time remaining in bull mode. And that's going to crush your option. And then, even worse, but still the end result is equally as sad, the stock retraces back to support, either the 20 or the 50. It holds support, but your options position is gone, because you're looking for the instrument to rise. It doesn't break major support. It just retraces back to it. Now, one way to avoid that is being really careful with your technical analysis and make sure you're trading off of support. The other thing that's important is to make sure that there's information crossing the ticker that's going to create a lot of buyer interest on a bullish position and a lot of bearish interest on a bearish position, and to keep that thing rolling in your direction. Now, these are the best options traders in the world, and these are for the most part not the guys that sell you their mentorship programs. These are the guys who publish their options recommendations, and the reason their recommendations cross the Benzinga ticker is because they go out on CNBC, or they go out on, I don't know, Moneyline or whatever it is, and they talk about them on TV. And then they're immediately converted to news, and they cross the ticker. I have John Najarian in here, but his brother too. Mike Kuo is always coming out with really great options trades, and Carter Worth, Andrew Keene, David Tepper, Kevin Kelly. I look for these guys' positions. I don't take most of them, but I like to see where they're going and what they're doing. Like, I didn't take John Najarian's recommendation for a bullish position on blocking on it. I just talked about it. I have it in my ticker. I didn't take that recommendation. And there were a lot of recommendations I sidestepped. But these guys know what's going on. They know where the big money is, and they talk about why they're taking the trade when it crosses the ticker. You just don't see a trade. Now, on Benzinga, you're going to see probably 100 trades cross the ticker a day, and some of them are really big money trades. Now, a lot of them are called sweep trades, and those sweep trades are weekly options positions, and usually they're very high risk, very high reward positions, where you'll have a trader buy a position, buy an options position for a nickel, looking to make 100 or 150% on an option sweep with a weekly expiration. You have to be very, very careful on the big options numbers and actually calculate how much is at risk. Now, I just wanted to show you some of the trades that we took. Now, remember, it's already a given. I mean, if you remember, the home builders, now one of the most profitable positions I have created this year was a deep out of the money 8-month, it had an 8-month expiration. It was way out of the money, and it was on the home builder ETF. It hit that strike price and rocketed through it. And when you catch a move like that, we made 200% on very, very, very little risk. So the home builders were really in bull mode. And I bought Pulte right here. 4,200 calls were purchased at the $20 strike. And what I look at is for cluster buying. 2,725 calls were purchased on another day at the $20 strike. And we were in at the $20 strike. And we made 98% on the position. The important thing was I made sure that the technicals on the stock were perfect. And this was trading just a little bit below support, but right at support. But down below, we had money flow positive, order flow and momentum positive, and this was a great position to take. And it went all the way to the value area high, where I should have closed the spread, but still in taking this bump, we still made 98%. And here was a position on Console Energy, which today got brutalized. I saw it got really hit hard. Now, there were 2,735 calls purchased at the $38 strike. It was a very large purchase, and it was a very expensive purchase. But I didn't want to take the risk that these traders took. But I knew what the strike price was. So I created a $38, $37 bull spread, and we made 175% on the spread just by following. Now, this is just a trade that crossed the ticker. I had to do my due diligence. I had to check the technicals. I had to make sure that everything was going to work. It did, and the trade was real successful. And here were the cues. This is a while ago, and this is a risk reversal spread. It's a very, very, very risky spread. What you do is you buy a call and you sell a put. And in the mentorship program, I'm going to show you how to create risk reversal spreads. The only reason you sell the put is to pay for the call. So you pay very little money for the spread. But the problem is you've got two bullish positions. The call you buy and the put you sell are both going to make money if the position goes up. But remember, what you want is to minimize risk, and you can't lose more than you pay. And the spread always limits your downside. So you've got a tremendous upside here, and you do have a big downside. But this thing shot right up. We profited $1.40, and that was 180% on this risk reversal on the Qs. Now, I know I can do this all day, and I'm just going to do this just for a few more. Now, iShares Mexico was another risk reversal I took, and it made 215%. And I should have held on to it, because it went up and up and up and up. It never stopped. Now, this was Weatherford International, and the reason I put this in here for a reason. Now, this was a 5,400 calls at the $6 strike, and this trade collapsed. And then just a couple days before options expiration, they hired the CFO of Halliburton. It shot the stock up. And remember, if you sell the day that the stock shoots up, the volatility of the volatility of the option skyrockets, the price skyrockets, and in one day we made 109%. This is FireEye. This is a Claro. Just following the footprint of other big traders that crossed the ticker. This is a phase 3 trial. I mentioned this is on Gilead. We bought it the night before at 31 cents. It was executed at market open because we caught everyone with their pants down. This phase 3 trial failure came in like 6 a.m. in the morning, and I don't think people saw it. We got we got the 31-cent call, and we sold it for 61 cents an hour later, just under 100%. And this is Home Depot. I have a Home Depot spread now. Now, here's how I set up the trades. Now, these are 5 trades I just closed about 2 weeks ago. These are brand new trades. And I have to tell you something. I closed these too soon. CME Group never stopped going up. But we had a bull call spread. I bought the January 18, 140, 145 call. I paid $230, and I sold. And to close it, I got a credit of $3. And this is what I create 2 metrics when I close a trade. One, the percentage, and one, the absolute dollar figure you make on each spread. Because if you buy a spread for 5 cents and you sell it for 10 cents, that's 100%. And if you asset allocate the exact same amount of money to that 5%, to that 5-cent call, then you'll probably make about the same amount of money on a spread that makes $70. But a lot of traders don't. So I want them to not only know how much money they made per spread, but their percentage. Chipotle, I also sold way too soon. It cost us $3.35. We got $5. We made 49%, or $1.65 per spread. I just bought a call on Interactive Brokers. I sold that also way too soon. It cost us $1.25. We got $1.75. We made 50 cents per contract. We made 40 cents. If I would have held that, we could have made 150%. But I don't have a crystal ball. I can't call tops and bottoms. And these things just surged ahead so fast. That's all I could do. I really felt bad because even when the market started to pull back, these 5 stocks just kept going up. Now, JB Hunt announced that they were going to buy Tesla's electric trucks. And that lit a fire under JB Hunt. And I was positive enough that JB Hunt was going to go up on that news that I just bought a call. I didn't buy a spread. I bought it for $1.50 and I sold it for $2.50, and I made $1. I made $100 for every contract that I traded, and I made 66%. On Home Depot, I also closed too early. It was the 170, 175 spread. I bought it for $2.45. I sold it for $3.25. I made 80 cents per spread. I just want to tell you one thing that I do, and I always recommend, that when you buy a spread, a 140, 145 spread, when you have to consider 145 as your price target. When your stock hits 145, you have to close the spread, because it certainly can go to 146, 147, 148, but you have defined risk and looked at the probability of this spread being successful on it hitting 145. That's how you calculate the probability of a win. And this is what you do in in Thinkorswim. So anytime a spread that I create hits my 145 price target here, I had to close it. And it hit it so quick, I had so much time premium. It's still not even January 19th. So what I left behind was a lot of time premium. The same with Chipotle. It hit it so quickly. It hit that, it was at 280, 287.50. Chipotle's trading way over 300 now. Now, if it would have held the spread, it would have made more money. As that time premium decayed, you start making more and more money on your spreads. But it hit my price target. Now, Interactive Brokers and JB Hunt I could have held. Those were just calls, and there was plenty of time left. They were both December calls, and these were November positions I closed. And Home Depot also hit my price target 175 real quick. Now, I don't think many people will tell you that, but when you create a spread, you create the probability of a successful trade based on it hitting your upper, the call you sold. When it hits it, you got to close the trade. So the number one goal in options trading is capital preservation. So it's very important that the spreads you create, the wonderful thing about a spread, and I really like to trade mostly vertical spreads. And sometimes I do risk reversal spreads, which are very risky. And sometimes I buy calls. You saw I bought a couple of calls, Interactive Brokers and JB Hunt. But what I like about a spread is it allows me and everybody who takes the trade to know exactly what their maximum potential profit is and what their maximum potential loss is. So if the spread closes out of the money at options expiration, it's where you're going to hit your maximum loss. If the spread closes above your target price at options expiration, you're going to garner 100% of your potential net profit. So it allows you to create a really accurate position size. Because if you buy a put or you buy a call, you can make a lot of money, but you can potentially lose a lot of money. When you buy a spread, everything is capped, and you can do your risk analysis and know exactly where you stand on the position. And I like that because we want to preserve our capital. And I'll tell you one position we lost that was a heartbreaking loser. I had a bull spread on CVS, and CVS was 50 cents away from its profit target when Amazon announced it was going to go into the pharmacy business. And their actual entry into the business is still up in the air. And the earliest it can enter is 2.5 years away. But just the announcement that Amazon, which is essentially the giant killer, was going to, at some point in the future, maybe compete with CVS, it ruined the spread, 50 cents away. That's why it's so important to be able to control your risk. Even though it was a hair away from a winner and it turned it into a full loser, the loss was still capped, and I knew exactly how much money I was going to risk on the trade, so it didn't put up any kind of major dent in my overall performance. And there's nothing you can do about things like that. If you had bought a call, you would have gotten murdered because you would have been up a lot of money and then you would have been down an enormous amount of money. So there's a big difference. So here's what I consider to be my 5 core principles of success when you trade options. Don't worry about the Greeks. I'm going to teach you what you need to know, and their application to actual trading, I think, is minimal. I mean, I'll tell you where I use them the most. I want to get into every spread, and I wanted to get into every call on a pullback. Now, in order for me to know where to create that pullback, I have to know the delta of the spread or the delta of the call or the delta of the put. And this is all done at night, so these are all approximate. And I always estimate on the side of being ultra conservative. So if I figure I could get a 2% pullback on the stock, and I multiply that 2% times, if it's a $100 stock, I'm looking for it to pull back $2. Well, based on the delta, how much is that going to drop the price of the spread? And that's where I'm going to place my order to open the spread. I'm going to create a net debit limit. I will not pay any more for the option than it is configured to trade down to if it pulls back by 2%. Now, I showed you Take-Two Interactive in the portfolio. I put in 4 trades. One was on Lowe's, one was on Home Depot, one was on Alibaba, and one was on Take-Two Interactive. We got awesome fills on Home Depot and Lowe's. The day we got into the trade, the position closed up, and today they're skyrocketing. We got a great fill. I didn't get a fill on Take-Two Interactive. Take-Two never pulled back, and I never got into the trade. But so what? I got into Home Depot and Lowe's, and I got in at a premium. Now, Alibaba's pulled back $6. So obviously we're in that. But the fact that I got it on a pullback means the amount of money I'm taking as a hit, which I believe is only temporary right now, is a lot smaller. So that's an important aspect. And I'm going to show you how to do that. And the mechanics of option spreads are also easy to learn. What you really have to do is understand what are the key stock catalysts, learn when to pull the trigger on a trade. My watch list is really important to me. I have 100 stocks on my watch list, and I almost always pull my trades off of my watch list. And then you have to learn the science of capital preservation, which is the key to profitability. Assess risk to each trade and allocate your capital accordingly. Now, it's very difficult to assess risk, but I think it's good to try to approximate risk. It ultimately will help you out. Now, we have a spread on Amazon that's doing relatively well. We have a 1,160, 1,190 spread. We're risking about $950 to make about $1,050. That's not a great risk to reward because it's about 1-to-1. That's the most you can get on a really powerful high beta stock like Amazon. You're not going to get a better risk to reward. And it's about $15 since we created the spread, so it's halfway to its target. And it still has a lot of time premium, so we don't have 50% of our profit, but it's moving in the right direction. But I would assess that spread as a 5. That's a high risk spread. The spread on DuPont, I would assess as a low risk spread. Whoops. Let me click that out. Now, let me talk to you really quickly about this because I'm going to run just a few minutes over because I want to show you Benzinga and I want to show you Thinkorswim. We have the SMS service. If you sign up, you're going to get text message alerts. I do a monthly review, a weekly review. So far, year to date, I sent out 185 emails for options alerts. I mean, that's almost for every trading day. That's like 3 out of 5 days you get an alert. We have the SMS messaging service. A month is $79. 3 months is $199. 12 months is $679. And I'm going to show you the performance. Now, here's the class. It's a 4-hour weekend class. It's next It's not this Saturday, it's the Saturday afterwards. I'm going to show you everything you need to know to trade. Now, I'm going to spend a little bit of time on fundamentals, but I'm going to spend a lot of time on the stuff that very few people show you how to do. And let me show you what I'm going to teach you. I'm going to teach you how to look and work this data feed. I'm not trying to sell it to you, only I would never trade without it. And understanding how to leverage it is really, really important. Like your news feed here is really key. Now you can put in any ticker you want. Like I put in Alibaba here. In fact, that was the last stock that you can put in anything that you want. You can put in AMZN, and it's going to bring up all the news that's crossed the ticker. It's up 0.7 today. CNET reported Amazon to start selling Apple TV, and it's moved Amazon. Where the heck is Amazon here? Now, I don't see it up. Well, I don't see it up that far anymore, but it was at the time of this announcement. So it's going to give you all the information that's relevant to Amazon, any major trades, anything that's going on. On the general ticker, let me just show you the news feed here. Open up a new window, and let me show you the settings. Here's the news feed. Now, hold on a second here. Right here. Now, I have audible alerts set to give me an alarm in my headset when there's a market moving exclusive, when there's an analyst. That's the alarm. Market moving exclusive, a major FDA announcement, I get alarms. I get little beeps. And then I want to see in my email so I can go over them at night and just review them at my leisure. All the market moving information, all the analysts' upgrades and downgrades. It takes me 20 minutes to do this because most of the stocks in which the analysts upgrade or downgrade, I have no interest in. So I just delete those. And I block out 40 emails in a row and just put them in the trash. I get all my earnings announcements and all the exclusives, and there's a lot of neat exclusives. FDA reports. I want to see any Forex issues, any futures issues. I want to see the insider trades. I want to see market updates. And most importantly, I want to see the options trades. And you can see I have an alarm. So if you saw, I'm actually going to show you my email. And hopefully I don't have any like derogatory stuff in there, but there it is. These are all Benzinga alerts in my email. Also I have a Burger King e-gift card I can get as well. But this allows me to go through these all real quickly. Listen, it's time intensive, but if you want to trade yourself, this is what you have to do. Right here, I can see that Roku is up 9%. It's up 150%. Now, I know I'm not going to chase it up, but what I look for is anything that's out there on positions in my portfolio. Here's Alibaba. Why this analyst investors should buy Alibaba's recent weakness. And you see it has a number 1 on it because it's in my watch list. Benzinga puts a watch list number on it for me. So I really get great information. I can leverage it out of my email, or I can just run the ticker, and it does create. Hold on one second. I'm sorry. I'm a single dad, and I've got a son, and he just sent me a text message, and let me just answer him, and I'm sorry, because he's at school and he's in a position of just give me 10 seconds. Okay. Okay. All right. So also, I can click on Roku. It's slow to fill here. Let me click on the ticker on Snap. I get a chart. Now, this is not a great piece of technical analysis, but it's not meant to be. It gives me any news that crosses on it. It gives me a lot of information, and then I can break it down. SEC filings, press releases, BZY or BZ signals, partner news, transcript summaries. So I really can hone down on anything that crosses here. And what I do at the end of the day, these reds are major news, something that could be a potential major market mover. Those are alerts. And what I do is I look for anything in my portfolio or anything that's on my watch list to give me an idea of whether I need to bail on a trade or whether I have a really good feeling that things are going to be heading in my direction and I can stay put. Now, let me quickly show you Thinkorswim. Thinkorswim is hard to show you because it's got my whole portfolio in it. And I'm gonna try to stick it in there. But I do want to show you how wonderful it is in terms of creating options. And here it is. Now, I could not trade options without this. I'm gonna give you an example. I'm gonna teach you how to work Thinkorswim and how to configure the most profitable options trade you can make with the least amount of risk. The information, the math is all in Thinkorswim. You just have to know how to use it. So it's a very practical piece of information. And you know what? You can know all the fundamental analysis in the world. You can know all the technical analysis in the world. But so you've got yourself a great stock. You've got great news on it. You've got FDA approval on a major drug. It's a biotech. It's in bull mode. You think that you have a great, all your analysis tells you that bull mode is going to continue. But what's the best position to take on the trade? And that is where the problem comes in. I got to pull my actual portfolio out of there because it's going to show you how much I think it still is. Hold on a minute. Let me just change the interface here because I don't want to show you that I don't think I'm up really nice money today. And let me just go to a trade. Okay. Now hang on one second here. Okay. Now I know how to block this out. It takes a little bit of configuring, but here's my trade on Home Depot. And you can see it's right here. Now, what I'm going to do, it's hard for me to do like this, I have to tell you. So here's the spread. And here's the risk profile. Here is the key piece of information you need when you take a trade. Now, first of all, you have to set the envelope at 5%. When I took this trade, my goal was to get a 5% move on the underlying. And that 5% is here and that 5% is here. So you can see with a 5, right today, the stock is trading at 182.74. But at the time that I created it, I could tell that I would reach the apogee and flattening out of this curve at about 4.8%. And I would obtain maximum loss at the same. This is the envelope wrap here. Now this is the value of the spread as the price changes, and this is the real-time value of the spread when it intersects the mathematical curve of the spread. So you can see right here, for every spread that's placed, we're up $236.08. If you created 2 spreads, you're up $480. So we're in a good spot. And the percent move that we need is a lot less than 5% to get to 100% profitability. Now, these 2 red lines are critical. This is where the option is going to be a break even today. And this is where the option price would be at expiration if if the price is here at options expiration, this is the lip of where you're going to lose money. If the price is here at options expiration, this is where you're going to move to profitability. This is right at break even on the trade. So in between this is where that spread is going to jockey for position. At options expiration above, you're in the money. At options expiration below, you're in the dumpster. So you can see we moved up nicely past this critical line, and the spread is only a small amount. We've only been placed it for 2 days, and it's already making nice money. This is what you have to look at. Now I'm going to show you one more screen, and here's your probability analysis. Now, when you take the trade, you have to look at the price that you need to get to in order to make 100% of your profit. And this curve is going to tell you what the probability is. And remember, this is a pure mathematical calculation based on the way the curve of the price of the stock is for that particular second at that particular time. It doesn't look at fundamental analysis. And what I've learned from experience is, right here it's telling you have a 16% chance for getting this price. And this price is, hold on a minute here, is $191.90. And we're looking at 126. So on 126, that's the probability that we would get that trade. And you have to look at these probabilities. Now, if you can get 15% or better on this curve, you're in good shape. Because this doesn't take into account technical analysis or fundamental analysis. It's simply a pure mathematical parabola of price. And it gives you an enormous amount of information. And after using this for many, many years, if you can get 15% out of this curve, you've got yourself a really nice trade as long as your risk profile is really good. And this shows you that your maximum reward on this trade, look, if you look in the lower left-hand corner, you can see the spread configuration. Now, your maximum loss on the trade is $1,410. Your maximum profit on the trade is $1,590. So just by looking at this curve, which is the best you can do on a big cap like Home Depot, is get a little greater than a 1-to-1 risk to reward. So all these metrics just work. The likelihood of getting a 5% move is high. We don't need much more to get there, and really we have a long time left in order to get up to where we need to be 100%. But even if the spread closed today at this price, we would be in the money. So I'm going to go into a lot more detail. It's hard to do this because what I have to do, I'm showing you this spread on the trade I took, but what we have to do is create sim trades. And what we have to do is see, here's the spread I took right here. It was the February 18, 180, 190 call spread. It's got a lot of time premium left on it. And I bought 3 spreads, which would net me about $1,200 in profit. And what you have to be able to do is go in and create a whole bunch of different spreads and look at the risk analysis, look at the risk profile, look at the probability analysis to determine what the optimal spread is. Now, when I took this, I didn't know whether to take an 80, 85 call spread or an 80, 190 call spread. And what gave me the answer was doing this analysis. This is what 80% or 75% of those 4 hours is. And this is what nobody teaches you. They teach you a lot of, they run through a lot of slides, but they don't go to a live platform to be able to show you how to trade. Now, this also has a really nice charting tool that I use. It's not my software, but I don't mind it because it really does give me a real fundamental look at what's going on. And when I take a trade, I want to make sure it simply hasn't broken support or it's not trading right up into resistance. And you see there's potential resistance, whoops, right here. I actually was able to draw a line. Now that's all the way up at 183.05. We don't need to get to 183.05 to reach maximal profit. Oh, we do. We have to surpass it. That's the area we would start to watch and start to look out for. You can see it's a top all the way across here. Oops. I'm dragging the probability envelope. I don't want to do that. I'm not so great with the drawing tool here. Here we go. Oh, that's a little low, but that's basically what we're looking for here. Whoops. Let me get rid of these trend lines. So this is where we would start taking stock of the position and be a little more careful. And if it took a big bounce off of this price, we'd have to watch whether or not we want to close. And you can see how Home Depot's moving. So let me see if there are any questions. I'm going to take Thinkorswim out. But we're doing really good. I'll show you the, let me see, I can detach gadget. Here's my watch list. Alibaba is actually up a penny now. Amen. Take 2, I don't have. There's Lowe's and Home Depot, Xilinx, Raytheon, Corvo, Autodesk, Salesforce, Amazon, Microsoft, $2. Amen. I have 20 spreads on Microsoft. Corning, there's Freeport McMohan. It's up 65 cents. It's a huge move. DuPont is down. Amcor, I have a call on, just a bare call. 41 cents. Amgen, $2. Albemarle, $3. And then Optoelectronics, which is a losing position already. So it's a very, very nice day for us today. Really nice. Let me close this and let me see if there are any questions. And let me just move the slides back. And even if you don't come on board, I hope you learned something. This is why 75% of my trades are successful, because I do so much work on them. And I really, really do spend at night. I sit on my cell phone in bed and I go through all these emails. And it really is a little bit daunting, but I've come to the point where I actually enjoy being a masochist. If you want to learn exactly how I take the trades, there are 4 positions left. I limit it to 10. We have 6 traders there because after the 4 hours is up, I answer all the questions, and I can't answer more than an hour's worth of questions. And if we have more than 10 traders, I just get too many questions. So there's 4 spots left, and that's the newsletter, where I really do an enormous amount of due diligence, and it does include the SMS text messaging service. If I see an intraday trade, we're going to grab it. So let me see if there are any questions. Okay. Al, let me tell you. Yeah, it's Freeport McMullen. Thank you, John. I can't, listen, as long as I know what I'm trading, I don't necessarily have to be able to pronounce it. Al, it really all depends upon how many spreads you want to create. I mean, you saw how many positions I'm holding. Right now, we have about 18 positions because it's a diversified portfolio. So it depends how much money you want to asset allocate. You can create 1 spread per position. You're going to need about $3,000, maybe $4,000. I mean, I have a lot more because I really believe in what I do, and we're up about 100% year to date. So I've about doubled my money in my portfolio, which is a lot more than the S&P has done. I think the S&P is up 23%. We're up 100% because I control risk. So if you can muster $3 or $4 grand, you can trade it fine, and you can take a sufficient number of positions on each trade in order to diversify your portfolio. I just recommend that you take every single position, because once we're too tech heavy, I stay away from tech, and I start looking for, that's why I grabbed Home Depot and Lowe's. And that's why I'm in Raytheon and Alba Marie and Freeport McMullen. I'm looking to diversify. So you should have a diversified options portfolio as well. It helps you preserve your capital, and it really does mitigate risk. So that's really the answer to that. So listen, everyone, thanks for coming aboard. I really appreciate your attention. If you want to give me a call, here's my number. I'll be here in the office. We're at 786-713-5276. We're in Florida. You can ask for Rory, but if you want to talk to me, my name's Mark. I'll be happy to talk to you. And here's our web address, and here's our email. So listen, everyone, have a really, really great afternoon. Thanks for your time. Have a really wonderful weekend. Take care. Bye-bye.